and the contrarian value portfolio, which is the very low growth portfolio, growing at a low rate and available on a low multiple. So as you would expect, the value portfolios outperform the glamour portfolios. But this is the really interesting thing. The low growth, undervalued portfolio outperforms the high growth, undervalued portfolio. And this is something really unusual, and I think it's something that is a little bit counterintuitive because we sort of like to think that high growth, undervalued stocks are bargains, gems in the rough. And it turns out that mean reversion acts on those portfolios as well to pull the high growth back and to improve the low growth. So this is just that previous slide with the glamour portfolio removed, just so we can see specifically. And the thing that I want to draw your attention to here is that the contrarian value portfolio in many of these categories is actually a little bit more expensive than the high growth portfolio. The reason possibly is that earnings are a little bit more anemic, cash flow is a little bit more anemic. So you can see on the book value basis, the high growth value portfolio was slightly more expensive. But it's very definitely growing much faster than the contrarian value portfolio. So the real driver of returns here was the undervaluation and not the rate of growth. And then there was some mean reversion as well, which pushed down the high rate of growth and made the high growth value less attractive over a period of time compared to the contrarian value. This was an earlier examination conducted by Michelle Clayman. There was a book written by Tom Peters that came out in the early 80s called In Search of Excellence. And Peters said that he'd identified the characteristics that created excellent companies. And he looked at a variety of these sort of quantitative, financial type elements. The book has been described as the book of the century, possibly by Tom Peters himself, but I've never read it. But I've read the research, and the research is compelling. These are his criteria for an excellent company. So they have very high rates of asset growth, very high rates of equity growth. They're expensive, and they have excellent returns on capital, assets, and equity. So Clayman said, well, let's create the opposite portfolio. Let's call them unexcellent companies, and we're going to find those with the worst asset growth, equity growth, low valuation, anemic returns on capital, equity, and assets. And then we're going to track their performance over a period of time. So the thing that I draw your attention to is just the valuation alone. And you can see here, this is some research that appears in the book. It was conducted by Barry Bannister at Stifel Financial. The unexcellent portfolios have vastly outpaced the excellent portfolios. For an early period of time, and it's difficult to see on this chart, the excellent portfolios did actually outperform the market, but not since. You get a better return investing in the S&P 500 than you do investing in these very high quality, high growth companies, these excellent companies. And you get a much better return investing in the ugliest of the ugly. The question that naturally people ask when they see that data is, well, is there some advantage to investing in the excellent portfolios because they offer some sort of risk protection? Is it a downside protection phenomenon? Is it that when the world goes into a recession, you want to be in these things that generate higher rates of growth? And the answer is no. Bannister looked at periods where the global growth was below average and above average. So above the line is when the shaded areas where global economic growth is below average, and the lighter areas where global economic growth exceeds the average. And you can see quite clearly there's no real method to when unexcellent outperforms or excellent outperforms. It does outperform occasionally, but it doesn't necessarily need a bad state of the world to do so.